The stock market is sending warning signals and investors are taking notice. With the S&P 500 entering correction territory, fears of a looming recession are growing. But what does this mean for your investments? Are we headed for an economic downturn, or is this just a short-term market dip? In this video, we'll break down what's happening, why investors are concerned, and how you can prepare for what's ahead. Before we dive into the recession fears, let's define what a market correction is. A market correction happens when a major stock index, like the S&P 500, declines 10% or more from its recent high. It's a natural part of market cycles and often signals investor uncertainty. Historically, corrections happen about once every 1 to 2 years, but not every correction leads to a recession. Right now, the S&P 500 has officially entered correction territory, meaning investors are adjusting their portfolios and market sentiment is shifting. There are several reasons why investors are bracing for an economic downturn. First, rising interest rates. The Federal Reserve has been aggressively raising interest rates to fight inflation. Higher rates make borrowing more expensive, which slows down business expansion and consumer spending. The bond market is flashing warning signs with an inverted yield curve, a historically reliable indicator of a recession. Second, inflation concerns. Despite efforts to cool inflation, prices remain high across many sectors. Housing, energy, and food costs continue to strain consumers, reducing their purchasing power. Third, corporate earnings are slowing down. Many companies are revising their earnings forecasts downward, citing weaker consumer demand and rising costs. When corporate profits decline, layoffs often follow, which can further weaken the economy. And finally, geopolitical uncertainty. Global conflicts, supply chain disruptions, and political uncertainty are making markets more volatile. Investors are worried about the impact of these risks on the broader economy. If the economy does enter a recession, here's what typically happens. Stock prices may fall further as companies struggle with lower revenue. Defensive sectors like utilities, healthcare, and consumer staples tend to perform better. Technology and high-growth stocks usually experience the biggest declines. It's important to remember that recessions don't last forever. On average, they last 10 to 18 months, and markets usually recover before the economy does. Smart investors aren't panicking, they're preparing. Here's what many are doing. 1. Shifting to defensive stocks. Stocks in healthcare, utilities, and essential consumer goods tend to hold up well during downturns. 2. Increasing cash reserves. Having more liquidity provides flexibility to buy stocks at lower prices if markets decline further. 3. Investing in bonds and fixed income assets. Bonds often perform better during recessions as interest rates stabilize or decline. 4. Diversifying investments. Investors are balancing their portfolios with commodities, gold, and international stocks to reduce risk. If you're an investor, here are key steps to consider. Stay calm and avoid emotional decisions. Market downturns are normal, and long-term investors tend to benefit from staying the course. Review your portfolio. Ensure you're diversified and not overly exposed to high-risk assets. Consider dollar-cost averaging. Investing consistently, even during downturns, can help reduce the impact of market volatility. Keep an eye on economic indicators. Job reports, corporate earnings, and Fed policy decisions will give clues about where the market is heading. While no one can predict the future with certainty, the warning signs are clear. Investors are preparing for a potential recession. However, history has shown that recessions and market corrections are part of the cycle, and smart investors use these moments as opportunities. What do you think? Are we heading for a major recession, or is this just a temporary slowdown? Let me know your thoughts in the comments below. Don't forget to like, share, and subscribe for more insights on investing and financial markets.